Today, I'm going to help you understand what is delinquent property tax. If somebody asked you that question, could you answer it? Well, by the end of this video, I'm going to help you understand exactly what it means to be delinquent on your property taxes, but also show you as an investor what you can do to take advantage of it. Does it make sense to you how some real estate investors are able to take advantage of delinquent property taxes? You might have heard the term delinquent property tax, but haven't been sure exactly what that means. But you've probably seen some investors who utilize that strategy year in and year out to produce massive wealth. Well, stick with me as I explain this process by first explaining what it means to have property tax and how they become delinquent. Secondly, I want to explain what those delinquent taxes mean to you as an investor. And finally, explain to you how tax liens and tax deeds work and fit into this whole idea of delinquent property tax. If you're ready, let's go. So what is a tax delinquent property? Well, to understand that, we've got to understand what property taxes are, right? So understand Uncle Sam is standing there with his hand out. He wants his pound of flesh. And so understand we pay taxes on everything. If you live in the United States, you're going to pay taxes on your income. You're going to pay it on the food you eat. And yes, you pay it on the property that you own. And those property taxes go to the governing agency, and that county or city municipality is going to use that tax revenue to build parks, roads, schools, libraries, a whole slew of things to make the community better. And understand overall, a property tax is an added expense for you as an investor when you're calculating how much money you owe every month to purchase a piece of property, right? You have the price of the home that you're buying, and it's broken down into a mortgage payment, principal and interest, and then you've got your taxes that are owed every single year that are broken down monthly, and the insurance owed typically every 6 months to a year that's broken down monthly. Now, understand most mortgage companies will take the full payment of all that I just explained, and they will divvy out and disperse the money owed to the insurance company and the money owed to the taxing or governing agency where taxes are paid. So a delinquent property tax is just that. It is property tax money owed to the governing agency that isn't paid. So if you own a home and let's say you're just making a mortgage payment and you pay your taxes separately, some of my investment properties are set up that way. If I stop making payments to the governing agency, they send out an assessment every year saying this is what your property is worth, this is how much taxes you owe on that property. And if I stop paying that, eventually that governing agency is going to put a lien on that property. Just like if you owned a home and you had somebody come and do some mechanical work in your home and they charge you $5,000 for the work that they did and you don't pay them, they're going to put a lien on that property because how else are they going to collect their money? The governing agency is no different, and they're probably a little bit more aggressive. So they will put a lien on that property, and eventually, if you do not pay that delinquent property tax, the government's going to take matter into its own hands, and it's going to take that property, gives them the right to sell that property at auction to recoup that money. And each state is a little bit different. Each governing agency is a little bit different. And each state is broken up into either a tax deed state or a tax lien state, depending on that governing agency. If it's a tax lien, they're selling the debt to an investor, where the investor then becomes the collecting authority, and they make an interest on that debt that is owed. And eventually, if it's not paid to them, if that debt isn't recouped, that investor who bought that tax lien can foreclose on that property and eventually get deed entitled to that property. If it's a tax deed state, it doesn't go into the whole tax lien certificate issue. It just sells the property outright as a tax deed, and the investor buys the property. They get the deed entitled to that property, and that loan or tax is satisfied. So now that we know what a delinquent property tax is, how do you find these properties that are delinquent on their taxes? Because there's a lot of them out there, right? Well, there's a handful of different ways to do that. You could actually go to your county assessor's office, say, listen, I'm looking to see if there are any auctions for tax liens or tax deeds on any property that have a delinquent tax. And they can give you a list of that and tell you when the auction is. And typically the auction is months out because the governing agency is trying to give the individual who owes the delinquent tax a curing period of time where they can make right on what is owed. And if they can clear that up with interest and penalties, they continue to own the property and continue to make payments, and then they owe more property taxes the next year and the next year after that. So going to your assessor's office is one way to do that. Another one, this is a free website called bidforassets.com. You can actually go there and look state specific of where they're having auctions for tax delinquent properties. It's a great tool, one that I've utilized many times. Now, once you find these properties that have delinquent property taxes on them, how do you move forward? Well, first off, you got to understand the majority of these auctions are cash only payments. Each auction will have their own rules, but you got to understand that you need to come to these auctions with a lump sum of cash. Whether you have money saved up to buy the home, or you've got a private investor willing to front you the money, or a bank that's willing to loan you the money, you have to have that money on hand. Because if you're the winning bidder, chances are you have to put some money right then and there down on that property, and you'll have 1 to 2 days to satisfy the rest of the balance. The second thing is you gotta have a strategy planned out for bidding. It's good to know home values in the area and the average home price in the area before you start bidding. Knowing this and understanding the market is gonna make you more informed as a bidder and as an investor. Remember, the home is sold to the highest bidder and you're competing against other real estate investors. So these are sharp individuals who are there trying to acquire a property just like you are. The final thing is following through with your investment. If you're the highest bidder, you must come to the table with cash or a cashier's check in order to be able to purchase the home that you just bid on as the high bidder. You must come and satisfy that, like I said, with a lump sum up front, and then 1 to 2 days to satisfy the balance. Either way, you've got to come to that auction financially prepared. Once you complete the transaction, you are the homeowner and you can enjoy the home as you wish, as an investment and one you live in, or turn around and flip and sell for a profit. So finding properties that have a delinquent property tax is a great strategy in real estate. Now there's other great strategies, and there's one that I've come up with over the last 12 months that I think is pretty innovative. I haven't seen anybody else out there doing it. It's called cash flow flipping. And I've got a full video where I explain this strategy in detail, and it's an amazing way to create cash flow every single month, but also build wealth. And you can do it in any market, in any condition, and anybody can do it. It really is that simple. It's understanding the concept. Just click on the video below and you can watch this strategy unfold and determine if it's a good fit for you. Thank you for stopping by. Have an amazing day.